With all the rate fluctuations going on, is now the right time to refinance? Or should you hold off? Well, with rates starting to decline, refinancing is a hot topic, but it might not be the best move for everyone. We'll dive into how to assess the current rate environment and help figure out whether or not refinancing makes sense for you, or if waiting it out might be the smarter play. Greetings, all you noble keepers of the real estate realm. Did you miss me? I know. It's been a hot minute since our last market update, but I promise I've got a good excuse. First, I got knocked out flat by a lovely little bug that apparently thought it was more important than our little podcast that could. I was out of commission for over a week, laid up kind of like a fixer-upper waiting on a remodel. But now I have crawled back into the land of the living. But just as I was getting back on my feet, boom, the phone started blowing up. Why? Because thanks to the Fed and the media, everyone that bought a home in the last 2 years was hearing all about interest rates dropping, and they all wanted a piece of the action. And let me tell you, with only so many hours in the day, I've been using up all of them. But hey, I'm back, I'm upright, and I'm ready to roll with a lot to share today. So speaking of those rumored lower rates, the main question that I'm hearing from everyone every day is now the time to refinance, or should you wait it out in case rates dip even further? That is the million-dollar question that we'll be tackling by the end of today's episode. So stick around for the answer that could save you some serious cash. This is the Texas Real Estate and Finance Podcast market update for the week of October the 8th, and I am your smooth-skulled Gen X host, Mike Mills, a North Texas mortgage banker with Geneva Financial. And almost every week, give or take the odd flu bug, I'm here bringing you the latest and greatest in all things real estate. We're talking interest rates, housing data, and those news stories that might have slipped past your radar, but are way too important to miss. And trust me, this week is no different. So grab your headphones or maybe a cough drop if you're in my boat, and let's dive into all the real estate tea for the week. All right, as always, we're kicking things off with mortgage rates. Now, if you've been keeping an eye on the headlines, you've probably saw that the Fed recently made a move to cut rates. But here's the kicker. Since that announcement, the mortgage rates have actually gone up quite a bit. Yep, you heard that right. So what gives? Well, I'll tell you where rates are now and where they were and what's really going on behind the scenes. Then we've got some signs of life in the housing market, actually. Housing sales are picking up. Pending sales have been rising and purchase mortgage applications have gone up for 5 straight weeks. It's not a massive turnaround yet, but with mortgage rates hovering closer to 6%, we're finally starting to see a few transactions shake loose. We'll dive into the latest data and see if the market is finally turning a corner as we start the fourth quarter of 2024. Then I've got a real bombshell local story out of Dallas here. Invitation Homes, the country's largest single-family landlord, is shelling out over $48 million over some pretty shady tactics against their renters. Hidden fees, neglected maintenance, unfair evictions, you name it. I'll break down the details of the FTC's case and what it means for renters moving forward. We've also got some eye-popping data on real estate investors making some big moves in the market as well. Turns out they've scooped up 1 in 4 of the nation's most affordable homes last quarter, totaling a whopping $43 billion in purchases. While this is great for investors, it's leaving a lot of first-time home buyers out in the cold. We'll dig into what's driving this investor surge and what it means for the market. And for the main event today, with all the rate fluctuations going on, is now the right time to refinance? Or should you hold off? Well, with rates starting to decline, refinancing is a hot topic, but it might not be the best move for everyone. We'll dive into how to assess the current rate environment and help figure out whether or not refinancing makes sense for you, or if waiting it out might be the smarter play. So stick around to the end for that one. All right, but before we keep going, let me ask a quick favor. If you're finding value in today's episode, whether it's a helpful tip, a fresh perspective, or even just a little chuckle, do me a solid and hit that subscribe button, leave a review, or pass this episode along to someone in your circle. I'm out here spreading the real estate gospel each week, but with your help, we can make sure our congregation continues to grow. And remember, if you or your clients need some guidance through that home buying process or thinking about refinancing that 7 or 8% interest rate from last year, don't hesitate to reach out and give me a call. Whether you need help with a new mortgage or you just got some questions about this crazy mortgage process, either way, give me a call. I'm here to help. But thanks again to everybody for tuning in. Y'all make this podcast what it is, and I'm grateful for each and every one. All right, let's get into the question that I get every single day of my life. Hey, Mike, what are the rates? Well, according to Mortgage News Daily, as of October the 8th of 2024, the average 30-year fixed conventional mortgage rate is 6.62. The average 15-year conventional rate is 6.15. The average FHA 30-year rate is 6.12. The average 30-year VA rate is also 6.15, and the average jumbo rate is about 6.75%. Now, I want to be clear. These are average market rates provided by Mortgage News Daily and may not reflect the specific rate that you qualify for. Mortgage rates can vary widely depending on factors like your credit score, loan type, and down payment, among others. For accurate information about your personal mortgage options, it's important to speak with a licensed mortgage professional like myself or your local lender. I just love that we're in this highly regulated industry. Got to say things like that. All right, moving on. So the Fed cut the Fed funds rate on September 18th. That's just barely 3 weeks ago. And as of today, October the 8th, mortgage rates overall actually have gone up by almost half a point from their lowest points in early September. So what the hell is going on? Well, the Fed did choose to go hard in the paint here and cut rates back by half a point back in September. They could have gone for a smaller quarter of a point cut, but felt that a heavier hand was necessary at that time, likely because of concerns over the weakening job market. But then, just like that, only 30 days later, we get a sudden turnaround in the BLS jobs report for September. The labor market, which seemed shaky and on a steady trend downward for the last 12 months, all of a sudden looks to be coming back strong with job openings rising and unemployment falling based on the most recent jobs report. So even though the Fed cut the Fed funds rate because of this big surprise in jobs data, but also a big surge in government debt, but more on that later, because of all of this, mortgage rates have actually gone up. So what happens from here? Are rates going to continue to go up, or is it just a blip on a bigger trend downward overall? Well, if you've been listening to my show over the last several months, you will know that, in my opinion, there are still too many factors showing that the economy is not quite as strong as some of this data would leave us to believe. And oh, by the way, I'm not alone in this opinion. However, markets move on data, and the data we have right now, at least, is telling us that the economy is booming. So until the data we get suggests otherwise, or until there's a major market moving event, then I would expect at this point for rates to stay above that 6% threshold, at least until the end of the year. Now, I do feel like we're living in the upside down here. What do I mean by that? Well, there is so much conflicting data out there right now that if you look at the jobs report that we got last week, there are a couple data points just within that kind of show you what I mean. So we had 254,000 jobs in September, which was well above the 140,000 job estimate. The biggest gains came from restaurants and bars adding over 69,000 jobs. Healthcare added about 45,000 jobs, and federal, state, and local governments added about 31,000 jobs. So hospitality, medical, and government. Same categories that have been adding to the job market pretty much since all this started. However, this jobs report had a massive seasonal adjustment, the biggest we've seen in quite a long time. In fact, if the seasonal adjustment had just been similar to what we had last September, we would have shown about 100,000 less jobs added to the economy from this report. Now, the household survey, which is where the unemployment rate is derived, reported 430,000 job gains, causing the unemployment rate to drop from 4.2 to 4.1. But small businesses actually saw a job loss of 128,000, which usually accounts for much of the gain. Also, average weekly hours worked declined slightly month to month, with an overall year-over-year decline of 3.5%. So that means jobs are up, but hours worked are down and wages are flat. And really, the most peculiar part of the September jobs report, at least in my opinion, of the 430,000 jobs gained in the household survey, 231,000 of those went to those aged 16 to 19 years old. And of that, 159,000 of those jobs went to those from 16 to 17, which raises a lot of questions given the school year started in September. Because at what point do we ever see so many jobs created for Americans that are in school and it not be in the summer? Again, just an interesting little quirk about this report. But hey, we are headed into spooky season, and that means that you're going to see those spirit Halloween stores popping up all over the place and all those empty retail shops that are all around you. So maybe the Halloween spirit store is single-handedly propping up the U.S. job market as we head into October. Just a guess. And just because I mentioned it earlier, another reason that's still kind of misunderstood that can cause mortgage rates to rise is U.S. federal debt. So the U.S. deficit has jumped $345 billion over just the last 3 days, hitting another record of $35.7 trillion. And since June of 2023, federal debt has surged by a massive $4 trillion or 14%. And over that same time, U.S. GDP is just about $1.5 trillion or about 6%. In other words, the national debt has outpaced the economic growth 2.5 times over the last 16 months. And outside of a pandemic crisis, the US federal debt has never grown so rapid. So, why does rising US federal debt matter to mortgage rates? Well, it's pretty simple. When the government borrows more money, it sells treasury bonds to raise cash. The bigger the debt, the more the bonds they need to sell. And when debt grows fast, like it has recently, investors want higher interest rates on those bonds because lending to the government becomes riskier. Now, here's where it connects to mortgage rates. Lenders look at those bond rates when setting mortgage rates. If bond rates go up, mortgage rates tend to go up as well. And even if the Fed cuts rates, rising debt can keep mortgage rates higher than we'd expect. Bottom line is, our national debt is growing much faster than the economy, and that can push mortgage rates up, making borrowing more expensive. So, even with the Federal Reserve forecasting more rate cuts this year, this sudden apparent shift in the job market and accelerating debt crisis makes it hard to see, at least right now, how mortgage rates get below 6% before the end of the year. But what do you think? All right, now let's dive into what's happening in the US housing market right now, because there's quite a bit to unpack. We're seeing a lot of mixed signals, and it's creating an interesting landscape for both buyers and sellers. First, let's talk about home sales. So, according to Mike Simonson from Altos Research, we're seeing signs of life in the housing market. Small, but meaningful. The number of homes under contract has risen slightly, climbing for the last few weeks. Purchase mortgage applications are also up for the 5th week in a row. In fact, purchase applications are up 9% compared to last year. So, when you have mortgage rates hovering just above 6%, that rate could possibly shake a few transactions loose. But let's not get too excited just yet, because these are small moves. It's not like we're seeing a big rush of home sales, but it's still a sign of recovery. And in this market, we'll take any sign of life we can get. Simonson also points out that these pending home sales are up about 6% from last year. And right now, there are about 362,000 single-family homes under contract. But the bigger question is, will this momentum keep up? Because as we move into the fourth quarter, typically you start to see a slowdown in the housing market. And the market has been overall pretty weak this year. So are we going to head further into the hole as we head into the fourth quarter? Or is this a sign that the market might start turning around? Inventory is another piece of this puzzle that's been climbing. We're seeing more homes come onto the market. In fact, 63,000 new listings this week alone. But it's still a relatively healthy pace compared to last year. In fact, inventory is up 6% compared to this time last year. But what's interesting is that some sellers who've been sitting on the sidelines for the last couple of years, especially in markets like Central Florida and Texas, may now be motivated by slightly lower mortgage rates to list their homes. However, there are some headwinds on the horizon. For example, with Hurricane Helene having just hit a big chunk of the country and Hurricane Milton expected to hit land tomorrow, next week we could see a large decline in inventory like in places like Florida, Tennessee, Georgia, and North Carolina. Natural disasters always throw a wrench in the market. And while we're praying for everyone in those areas that are affected, as a result of this, we can expect to see overall inventory numbers decline. What about home prices now? Well, they're holding steady, which is somewhat surprising given how weak demand has been all this year. According to CoreLogic, home prices were only down by 0.1% in August, but year over year, they're still up almost 4%. CoreLogic is also forecasting only a modest increase of 0.1% for September and a 2.3% rise over the next 12 months. So that's pretty conservative, but it's still growth. And it just means that we're not seeing the big price corrections that a lot of home buyers were hoping for. And interestingly enough, the median price of homes in pending contract has ticked up for the 3rd week in a row. It's now just sitting under $390,000. That's a good sign for the overall market that buyers are still willing to pay competitive prices for the right property, but maybe not the best sign if you're hoping for prices to come down and become more affordable. So when we step back a little bit and look at some broader trends, right now, only 25 out of every 1,000 US homes has changed hands between January and August of this year. That's the lowest turnover rate that we've seen in at least 30 years. And it's a sign that the US housing market is essentially frozen. Elevated mortgage rates, record prices, and a low supply of homes are the big culprits behind this. And in places like Los Angeles, the situation is even worse. Just 15 out of every 1,000 homes changed hands for the first 8 months of the year. That's the lowest turnover rate among major metro areas in the entire country. And on the flip side, The rate of homes being listed for sale is almost at its lowest point in 12 years. Just 32 out of every 1,000 homes is being listed. So while there is big movement in the market with more purchase applications, it's still very slow compared to historical standards. Right now, we're about 30% below pre-pandemic levels in terms of home sales. Now, one area that has seen a lot of action is refinancing. Refinances are down 3% from last week, but are up a staggering 186% compared to this time last year. Right now, refinances are making up about 55% of total mortgage applications. And this is the highest level of refinance activity that we've seen since April of 2022. Because rates have come down more than 1% over the past few months, and homeowners with higher rates are starting to take notice. But after rates ticked up again this week, above 6.5%, I would expect that we would see this trend start to fall off pretty heavy. But let's not forget, mortgage rates are still high by historical standards. So while rates have improved over the last year, they're still keeping some buyers on the sidelines, and it's taking time for these lower rates to translate into more purchase activity. Honestly, I would expect it to take rates getting down to the low fives to start really seeing people get off the sidelines and list their homes to buy again. So where does that leave us? Well, the housing market is thawing, but very slowly. It's still constrained by higher mortgage rates, limited supply, and prices that remain stubbornly high. We're seeing a few signs of recovery, but don't expect a massive shift anytime soon. As we head into the end of this year, all eyes will be on whether or not momentum carries us into 2025. And remember, as Mike Simonson points out, the housing market can change fast, and smart decisions need to be made with the most up-to-date information. Keep an eye on rates and inventory levels, and have your clients prepared to make a move when the time's right. Okay, next up, we got some news stories in and around the world of real estate that you may not have heard about, but you and your clients definitely need to know. So, think renting is cheaper, safer option perhaps? Think again. While it might save you money up front, companies like Invitation Homes are adding hidden fees and cutting corners, making renting far more expensive in the long run. Recently, the Dallas Morning News highlighted how the corporate landlords are quietly driving up costs for renters and what it means for your wallet. So, Dallas-based Invitation Homes, the largest landlord of single-family homes in the country, has agreed to pay $48 million in a settlement. The Federal Trade Commission, or FTC, led the case, accusing the company of engaging in unlawful practices that affected thousands of renters. So, what exactly are they accused of? Well, according to the FTC, Invitation Homes was charging junk fees, and the kind of fees that we're talking up to $1,700 a year in extra costs for things like smart home technology and utility management. And these fees were not disclosed up front, and tenants had no way to opt out of them. So imagine you're signing a lease thinking that you're paying one price, only to find out later that your monthly rent is significantly higher. And since 2019, the company reportedly collected over $18 million just in application fees alone. But that's not all. Invitation Homes also failed to inspect homes before tenants moved in. In fact, between 2018 and 2023, over 33,000 properties submitted work orders for things like mold, broken appliance, and even unsafe wiring. And some tenants were left in dangerous conditions without emergency maintenance, which was supposed to be provided 24/7. And for a company managing such a large portfolio of rental properties, that is a serious failure. Another issue was the company's handling of upfront security deposits. You see, the FTC found that Invitation Homes only returned about 39.2 of these required upfront deposits between 2020 and 2022. And that compared to the national average of around 64%. That is a massive gap. And it shows just how widespread these unfair practices were. And one of the more troubling accusations relates to their eviction practices during the pandemic. Instead of guiding tenants to file CDC eviction protection forms, which would have offered some relief, Invitation Homes allegedly directed them to complete a hardship affidavit, a form that didn't actually protect tenants from eviction. Even worse, the company sometimes pursued eviction proceedings after renters had already moved out. Those eviction records then appeared on tenant screening reports, making it harder for those individuals to rent in the future. Now, this $48 million settlement is a big deal, but it's worth noting that Invitation Homes hasn't admitted to any wrongdoing. They said that this agreement will allow them to move forward and improve their practices, which of course we certainly hope happens. And as part of the settlement, the company will need to clearly list all fees and advertise rental prices and stop withholding security deposits for normal wear and tear. So housing advocates do see this as a potential turning point for regulating large institutional landlords. Sharon Corneliuson for the Consumer Federation of America pointed out that junk fees have no place in housing, especially as millions of renters are already struggling with rising rents. So, what does this mean for renters? Well, it's just a reminder to always be aware of what's in your lease and to ask questions if something doesn't seem right. If you're seeing extra fees that weren't disclosed up front, that's a red flag. And for those of us in the real estate world, this is just another example of how the mom and pop landlord is slowly being replaced with corporate overlords. And with home prices, interest rates, and insurance and taxes at all-time highs, renting is becoming the best option for more and more Americans. The problem is that once you get into that cycle, and your housing costs are 100% controlled by an entity with no heart or compassion and whose only goal is to improve the bottom line for their shareholders, the more of this kind of stuff you're going to get. Okay, look, do corporate landlords own most of the single family properties for rent? No. They don't. It's still a very small fraction of the overall market. But remember, Netflix only had a small fraction of the movie rental market back in the 90s. Back in the days where the mom and pop movie rental place and Blockbuster was working its way in. But today, Blockbuster's gone, all the mom and pops are gone, and your Netflix subscription that used to be $4.99 a month is now $6.99 a month if you're willing to watch commercials. And if you're not, then you're paying $22.99 a month with no commercials. So things happen and change, sometimes slowly, but they change. The point being, just because today big corporate interests don't own a large share of the market doesn't mean that in 10 years they won't control the vast majority of single family rentals. And if you don't own a home, then you will be subject to their terms. So we'll keep an eye on how this settlement unfolds and whether it leads to better practices in the rental market. But for now, this $48 million fine is a win, at least for renters who've been dealing with all these unfair practices. I just hope it is in the short term. Okay, now speaking of market dynamics shifting in the rental market, imagine this. You've been saving your money, building your credit, and waiting for rates to get to the right place in time for you to make your move into buying a new home for you and your family. Meanwhile, in markets all over the country, investors big and small are buying 1 out of every 4 affordable homes in the United States. That's right. Affordable homes are being snapped up by big money, pushing the dream of homeownership even further out of reach for your average everyday American. So, what's driving this surge and how is it making housing even more expensive? Let me show you. So, according to a recent report by Redfin, 1 in 4 affordable homes sold in the second quarter of 2024 were snapped up by investors. That's up 3%, and it's the biggest surge in investor activity since 2022. So, why are investors eager to get back in the game? Well, elevated home prices and rising mortgage rates have put homeownership out of reach for a lot of Americans, especially first-time homebuyers. Many people who would have been looking to buy now are turning to the rental market instead, and investors are taking full advantage of that shift. As a Redfin senior economist put it, investors, many of whom can pay in cash, are cashing in on the increased demand for rentals. And just to give you an idea what's going on with home prices, the national median home price for a single family home went up 4.9% compared to last year, hitting $422,000. That's making it even harder for everyday buyers to break into the market, which is great for investors, but tough for the middle class. We're also seeing significant regional trends. Cities like San Jose and Las Vegas saw the biggest jump in investor purchases, up 27% year over year. And other major California cities like Sacramento, Los Angeles, and San Francisco aren't that far behind. But here's the flip side. As investors grab more homes, California's homeless population has surged to 7.5% between 2022 and 2023, now accounting for nearly 1/3 of the nation's homeless population. And here in Texas, we led the nation in homes purchased by investors in 2021. According to the National Association of Realtors, 20% of all homes sold that year went to an institutional investor. And that share was even greater in exceptionally high growth markets like where I live in Tarrant County, where investors accounted for some 52% of the home sales that year. Look, it's a tough situation because on one hand, investor activity can stabilize a volatile market. But on the other hand, it can drive up prices and make affordable housing even harder to come by. And the growing gap between home ownership and renting is creating long-term challenges, especially as new construction starts to slow. With less new housing being built, rents are expected to rise in the coming months, making it even more difficult for those who were priced out of the market to buy. And there's also big money moving into the multifamily sector as well. Just this month, Equity Residential bought 11 apartment complexes for $964 million. And that's the largest multifamily acquisition by a public real estate investment trust in the last 7 years. That is a clear signal that investors are betting on the rental market staying strong as homeownership becomes less accessible for the average American. So what's the takeaway? Well, the housing market is undergoing a major shift. And for many, the dream of homeownership is slipping further and further away. Investors are capitalizing on rising rents and limited inventory, which could lead to even higher costs down the road. Look, right now, nobody on the planet wants to hear about why they should go out and buy a home, especially from a mortgage guy like myself or their local realtor. But just like many other things in life, we are all so busy living our day to day and just trying to support our family that these big economic shifts that can take years to really start to show in the data and get people concerned is something most Americans just don't have time to pay attention to. That's why, as a realtor, your job is to pay attention to this stuff and keep your clients aware of the opportunities and threats affecting their ability to own real estate. That's why I'm here each week making you aware of this stuff and why you need to be active in looking for these types of stories that will ultimately impact your client's ability to own a home. So, I'll be here continuing to beat the drum for the American dream of homeownership. And with your help, hopefully, we can get enough people to pay attention and finally do something about it. We're all in this together. All right, let's get into the heart of today's episode. So, mortgage rates went down, then they went right back up. Did you miss the boat on refinancing your mortgage, and have you lost your chance to save thousands on your housing costs? Today, we're going to talk about whether it's time to refinance now or if there's another opportunity coming down the road. So, if you're sitting on a higher rate from a home that you purchased in the last couple of years, or your debt load is drowning you in monthly payments, then this is for you. All right, so let's start with the recent roller coaster that we've been on with mortgage rates this year. Back in September, we saw the Fed take its first action to cut rates in a very long time, hoping to give the economy a little boost because of rising unemployment and slowing inflation. The expectation of that move caused mortgage rates to drop significantly in the months leading up to that September Fed meeting, almost over 2% drop in rates. And for a while there, with rates hovering just above that 6% mark and the promise of the first rate cut on the horizon, it looked like the perfect opportunity for homeowners to refinance and lock in some serious savings. But then, as it always does, the market didn't do what everyone was expecting. And just when people thought they saw a window to jump in, rates have shot back up over 6.5%. Look, the mortgage market can be unpredictable. And while rates most likely will dip again, there's really no guarantee that they'll stay low as we close out this year. Because lately we've seen a lot of economic inconsistency in the data. And with 30 days until this year's election, nothing is for certain in the market right now. So for homeowners who locked into those higher rates over the last 2 or 3 years, it can be very, very frustrating. You see those lower rates, and then before you can act, they just disappear into thin air. The big question is, what happens next? Could rates go up even more? Or will there be another opportunity to refinance later this year? That's the dilemma that a lot of people are facing right now. The important thing here is to stay alert. We've seen how quickly rates can change, and if they drop again, you'll want to be ready to take advantage of it. Now, let's talk about who should be considering refinancing. Whether you're looking to lower your monthly payments, get a better rate, or tap into your home's equity, refinancing can be a smart move if the time is right. First off, if you're someone who's sitting on a lot of high interest debt, think credit cards, car loans, or personal loans, tapping into that home equity through a refinance could be a game changer for you. You see, mortgage rates, even when we're in the 6% range, are still lower than interest rates on most credit cards, which can run anywhere between 15 to 25% right now. Imagine paying off all that high interest debt and rolling it into a single lower monthly mortgage payment. Not only does that free up some breathing room in your monthly budget, but you'll also be saving a lot of interest over the long run. Next up, there's a group of homeowners who bought a house in the last 2 or 3 years when rates were higher than they are right now. Many of you are locked into mortgages with rates above 7%, and even though rates have gone up again just recently, they've dipped before, and they will dip again. So when the opportunity presents itself, refinancing could mean big savings for you. Even with just a slight drop in rates, say between 6.5% to 6%, that could translate into thousands of dollars saved over the life of your loan. Then we have folks out there that are getting very close to some major life events. Retirement, sending kids off to college, or even planning for a big family expense. Refinancing now can give you access to that home equity when you need it the most. By tapping into your home's value, you can create a financial cushion for yourself during these uncertain times. And let's be honest, with so much unpredictability in the market, having a little bit of extra flexibility could make a huge difference in your household budget. But here is something important to remember. Timing the bottom of the market isn't everything. A lot of people hold off on refinancing because they were waiting for that perfect rate. But here's the reality. If you wait too long, you might miss the boat entirely. Even if rates aren't at rock bottom, refinancing at a slightly higher rate can still make sense, especially if you're carrying high interest debt or need to lower your monthly payments. It's all about what's best for your situation right now. The key takeaway on here is this. Don't focus on hitting the absolute lowest rate. If refinancing can save you money today, help you consolidate debt, or give you the flexibility to handle life changes, it could be the right move, even if rates aren't at their lowest. Now, Let's assume you find yourself in a place where you think refinancing might be the good move now or in the very near future. Before you jump in, though, there are a few important components that you need to consider. Let's talk about the costs involved, the timing, and the key questions that you should ask your lender to make sure refinancing works in your favor. First, one of the big factors to pay attention to is timing. As we've already discussed, mortgage rates have been on a bit of a roller coaster this year. Rates dropped earlier in 2024, but they've recently shot back up again. So if you're looking to refinance, it's essential to stay informed about interest rate trends. Keep an eye on any decisions by the Federal Reserve or major economic indicators like inflation, war, and job numbers, because these things could push rates up or down in the coming months. And if you really want to try and nerd out, watch the 10-year Treasury bill. If it goes up, rates are going up. And if it goes down, often mortgage rates are going to follow. Timing is everything. Refinancing at the right moment could save you thousands over the life of your loan. Now, let's consider the costs. One of the most important questions to ask your lender is, what are the costs involved? Closing costs on a refinance can range anywhere between 2 to 5% of the loan amount. So it's crucial to understand what exactly it is that you're paying for. These costs typically include appraisal fees, title insurance, origination fees, basically anything that the lender has to pay on your behalf to do the loan. And once you know these costs, the next question to ask is, how long will it take me to break even on these costs? This is key because refinancing only makes sense if you'll stay in the home long enough to recoup those costs through the savings from your lower rate or your credit card monthly savings. So to calculate your break even point, you divide the total amount of your closing costs by your monthly savings after the refinance. For example, if you save $200 a month and your closing costs are $4,000, it will take you 20 months to break even. And as an industry, we say if it takes you less than 3 years to break even on your costs, then it's a good move. If it takes you 3 to 5 years to break even on your costs, then it might be something that you consider a little bit, depending on if you plan on staying in that house or not. And if it takes more than 5 years for you to break even on your costs, then it's probably something you need to hold off on. And here's something that a lot of homeowners don't fully realize. You may be able to roll some or even all of the costs into your new loan. This is especially helpful if you don't have the cash up front to cover the closing costs, but you'll need to ask your lender if that's an option for you. Often these options come down to how much your home is worth and what your current equity position is. Just keep in mind that rolling costs into the loan means that you'll be paying interest on those fees over time. So make sure it still makes financial sense. Another important question to ask your lender is, can I lock in today's rate? Rates can fluctuate from the time you start your application to the day that your loan closes. So locking in your rate early can protect you if rates go up. And many lenders, like myself, offer what's called a float down option, which means that we can lock your rate, but if the rate falls before you close your refinance, you might have the option to get the lower rate even after you've locked it. But also ask, what happens if rates drop again after I refinance? It's a good idea to get some input from your lender on where rates would have to fall from where you are now in order for a refinance to make sense again, if rates keep dropping. And lastly, timing really does matter. Don't forget to ask your lender about their perspective on upcoming rate trends. Are rates expected to rise, or could we see another dip in the near future? Staying informed about the market can help you better decide on whether to refinance now or wait for a better opportunity. Okay, just to wrap things up, a couple of reminders. We've seen rates go up and down this year, and while they're back up right now, that doesn't mean the opportunity to refinance is gone. Whether you're carrying high interest credit card debt, stuck with a higher mortgage rate from the last few years, or preparing for a major life event like retirement or college, refinancing could be a smart financial move if the time's right. Secondly, timing matters. You'll want to keep an eye on upcoming Fed decisions and market shifts. But just important are the costs. Make sure that you understand the closing costs involved, calculate how long it'll take you to break even, and talk to your lender about rolling costs into the loan if needed. And don't forget to ask about rate locks and what happens if rates drop after you refinance. The key is staying informed and working with a lender who can guide you through the process. Now, if you're not sure where to start, reach out to a mortgage professional to get personalized advice. And if you need a trusted referral, ask your local realtor. They can connect you with a lender who will help you explore your options without all the pressure. Or you could just give this old bald podcaster a call as well. I make these videos to help people understand how crazy the mortgage stuff works. And I know because I do them every day. So if you want some expert insight on if now is the right time to refinance, give me a call. I'd be happy to walk you through it. The bottom line is this: don't wait until it's too late. Refinancing could save you money today, help consolidate debt, or give you flexibility to handle what life throws your way. So take the next step, talk to a lender, review your mortgage, and see if now is the time to refinance. All right, guys, that is a wrap for today's episode. I hope you found our discussion on rising mortgage rates, refinancing, and the big moves institutional investors are making in the housing market insightful. Whether you're a homeowner thinking about refinancing or someone worried about the future of affordable housing, there is a lot happening in today's real estate world. And remember, the market may be shifting, but that just means that there's opportunities if you stay informed and act intelligently. Join me this Thursday as I welcome back a good friend and regular of the show back to the podcast, Mr. Conrad Jackson. Conrad's a realtor, builder, investor, YouTube star, and a good friend. We'll be diving into ways you can uncover opportunities for income in this slow market. So if you like money, you don't want to miss this one. As always, I appreciate each and every one of you guys out there for being a part of this community and for tuning in. So until next time, be good humans, just keep grinding. Life is what you make it, so make it great. See ya.